In the final days of 2025, Nvidia was linked to two AI deals reportedly worth a combined $34 billion. On the surface, they look like massive wins. But here's the problem investors need to understand. One of these deals could disappear overnight due to U.S. government regulation. The other might never pay off the way the market expects. Together, these moves tell us something critical about Nvidia in 2026. Nvidia is still the dominant force in AI infrastructure, but that dominance is now under pressure from three directions: regulation, inference competition, and customer diversification. If you own Nvidia stock or you're thinking about buying it, this video is not about hype. It's about the signal these deals are sending. Before we break down the deals, we need to set the baseline. Nvidia dominates AI training today. Its H200 GPUs and the upcoming Blackwell platform power the world's most advanced AI models, large language models, autonomous systems, enterprise AI. Jensen Huang summed it up clearly. We believe AI will touch every industry, and our GPUs and ecosystem are central to powering that transformation. That statement is backed by numbers. Nvidia controls roughly 70 to 80% of the AI training GPU market. Right now, they're the toll booth for AI infrastructure. But here's the inflection point investors need to focus on. By 2030, inference, running trained AI models in real-world applications, is expected to account for around 75% of total AI compute spending. We're in 2026 now. Training built the AI brain. Inference runs it at scale, and Nvidia is racing to own both. That's why these two deals matter. Let's start with ByteDance. TikTok's parent company has reportedly signaled intent to purchase up to $14 billion worth of Nvidia's H200 GPUs in 2026. But investors need to be very clear about one thing. This is not confirmed revenue. The deal is conditional. The U.S. government has not yet approved export licenses for H200 chips to China, and Chinese regulators have not formally approved the transaction either. What this means is simple. ByteDance wants the chips if regulatory approval happens. That's very different from a locked-in order. Why does ByteDance want them? Because the H200 GPUs dramatically accelerate AI training and large-scale inference. For a company running recommendation engines, content generation, and AI-driven engagement at TikTok scale, this hardware is mission-critical. The signal here is real. Even under geopolitical pressure, global demand for Nvidia's hardware remains intense. Companies are willing to spend billions just to secure supply. But here's the investor reality. If the U.S. denies export approval, this $14 billion disappears. Not delayed, gone. That alone could trigger stock volatility. So here's what actually matters going forward. In Nvidia's Q1 2026 earnings call, listen carefully. If management mentions regulatory progress, that's a positive signal. If they avoid the topic or repeat ongoing discussions, that's a warning sign. Now let's talk about the more controversial move. Nvidia has been linked to a deal with Groq, an AI inference chip company, reportedly valued at up to $20 billion. What makes this unusual is how quiet it's been. There was no major press release, no detailed SEC filing. The information surfaced primarily through a short Groq blog post. That lack of transparency has raised eyebrows. Here's the likely reason for the structure. Rather than a full acquisition, the deal appears to be framed as a non-exclusive licensing and strategic integration. Why does that matter? Because Nvidia is already under regulatory scrutiny. An outright acquisition of an inference competitor could attract antitrust attention. Licensing and integration, even at massive scale, draws far less scrutiny. So what does Nvidia actually gain? Groq specializes in AI inference, running trained models efficiently with low latency. In theory, this helps Nvidia position itself as a full-stack AI platform. Training hardware, inference hardware, software ecosystem. That's powerful. But this is where skepticism comes in. Groq's current chips work well for narrow, specific inference workloads. They struggle with very large, memory-heavy models that require flexibility. Several analysts have called this deal a gamble. The question is simple. Is this a brilliant early bet on inference dominance, or an expensive shortcut Nvidia could have built internally for far less? The honest answer? We won't know for 2 to 3 years. What investors should watch in 2026 is adoption. If major cloud providers, AWS, Azure, Google Cloud, begin offering Groq-based inference at scale, this validates the strategy. If Groq remains niche, this deal becomes a serious question mark. Here's what most investors are missing. While Nvidia is betting on Groq for inference, ByteDance is building its own AI chips. ByteDance is working with Broadcom and TSMC on custom accelerators expected to debut in 2026, the same year it may buy Nvidia hardware. And that's not all. ByteDance is also reportedly planning to order over $5 billion worth of Huawei Ascend processors. This tells us something important. ByteDance is not betting everything on Nvidia. It's hedging. And this pattern is everywhere. Google built TPUs, Amazon built Trainium and Inferentia. Microsoft is developing custom Azure accelerators. They still buy Nvidia chips because Nvidia is the best right now. But they're actively reducing long-term dependence. That's not a short-term threat, but it is a long-term erosion of Nvidia's moat. So what does all of this mean for investors? Revenue growth, conditional. The ByteDance order would significantly boost 2026 revenue if it's approved. This is real demand, but not bankable revenue yet. Strategic positioning, high risk, high reward. The Groq deal strengthens Nvidia's inference story on paper, but the technology is unproven at scale and execution risk is real. Competitive advantage, shrinking, not gone. Nvidia still leads the AI hardware market in 2026, but the gap is narrowing as customers build alternatives. Here's the translation. 2026, strong revenue, regulatory-driven volatility. 2027 to 2028, growth moderates as custom chips mature. 2029 and beyond, Nvidia becomes one of several major AI infrastructure players, not the only one. Your investment outcome depends entirely on your time horizon. Here's what actually matters. 1. ByteDance wants Nvidia's chips, but regulatory approval is not guaranteed. This is conditional revenue. 2. The reported Groq deal strengthens Nvidia's inference strategy, but carries real execution risk. 3. Nvidia dominates today, but its biggest customers are actively diversifying away. 4. 2026 will be a volatile year for Nvidia stock, driven by regulation, adoption signals, and competitive announcements. The bottom line? Nvidia is not broken in 2026, but it is no longer an unstoppable infrastructure monopoly. It's a dominant leader in a rapidly evolving, increasingly competitive market. Thanks for watching. This channel focuses on AI infrastructure, regulation, and investment-level analysis, not hype. If you want to stay ahead of earnings signals, policy decisions, and competitive shifts, subscribe and turn on notifications. In AI, the biggest moves aren't loud. They're structural. Understand the signal, not just the story. I'll see you in the next one.